Welcome. Can I start off by saying either a good morning, good evening, or a good afternoon, of course, depending where you are around the world. And welcome and thank you for joining me on tonight's latest webinar for Stratton Markets. Tonight's episode is called How I Came to Understand Momentum Indicators. Written by myself, of course. This is James Trescothick, and I'm the head of investment research. Now, before we get on to the introduction on myself or tonight's agenda, here's obviously we're talking about CFD and online trading, and like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know of the risks at hand for entering any trade. Now, this black and white picture of this rather devilishly good-looking man, I'm joking, of course, is myself. Like I said, my name is James Trescothick, and I'm the head of investment research here at Stratton Markets. I have over 20 years experience in the financial service industry. Started off as a mortgage broker before I moved into pensions, and then of course on obviously trading. I've traded myself for several prop companies, ran a floor at the Philippine Stock Exchange, and traded gold through the Dubai Gold and Commodity Exchange before moving into portfolio management and then later education. I'm a published writer, and I've been published in many leading industry publications, including the likes of the Financial Times Advisor, Market Watch, to name just a few. I'm an avid market commentator. I can be extremely passionate about this marketplace, and I'm a well-known public speaker. I've spoken at several events around the world, including the likes of Dubai, Qatar, Kuwait, KSA, Singapore, Philippines, South Africa, Joburg, Pretoria, Cape Town, Berlin, London, just to name a few. Now, tonight's agenda, like I said, it's called how I got to understand momentum indicators, in other words, oscillators. And we'll just discuss what they are, obviously, initially when we will start. Then we'll talk about the theory behind oscillators, and then examples of the many oscillators out there. And then we will do market examples of only two oscillators. We'll only do a couple. And then we'll talk about the May schedule and the remainder of April schedule, and then question and answers at the end. So what are oscillators? Oscillator is a type of technical analysis indicator which can potentially be used by a trader to identify if a trend might change, and at the same time find if an asset is potentially overbought or oversold. It is a leading indicator, okay, which tends to be used to point at future direction of an asset or a change in trend, whereas lagging obviously will confirm like if a trend is actually happening. Now, this potentially works when an asset is at extreme value in either overbought or oversold areas. This is what leading indicators try and focus upon. Now, the theory behind stochastic oscillators is developed by a man called the name George Lane, excuse me, in the 1950s. And oscillators calculate the closing price of an asset in conjunction of the high and the low of the range over a period of time. So it really is so the speed of the fluctuation of an asset. In theory, the oscillator follows the momentum of the price, like I say, the speed and the fluctuation of the asset price before the actual price actually changes. And this is why some traders try to use it to predict a sudden change in direction. Now, George Lane also said that stochastic oscillators can identify when an asset is reaching either oversold or overbought levels. The theory is that if an asset reaches overbought levels, the asset might experience a sudden sell-off, and if the asset reaches oversold levels, the market might jump in and start to buy in again. Now, there's many examples of momentum or oscillators. These include the following. And these are probably the most popular, most well-known. the relative strength index, parabolic SAR, moving price, so moving average convergence divergence, commodity channel index, average directional index, detrended price oscillator. Now, we're just going to focus on two for tonight. We're going to talk about the moving average convergence divergence, MACD, and the RSI. Now, the theory behind this indicator is that it can help identify when the direction of an asset may change to either a bullish or bearish direction. MACD is setting up really maybe three numbers you're reading, okay? The number of periods of the faster MA, the number of periods of the slower MA, and the number of bars used to calculate the difference between the two. The theory is that unlike say a simple moving average, which is calculated on price, but not the difference between the two MAs, but the MACD sort of calculates the difference between the two, the fast and the slow. The histogram or bars plots the difference between the fast and the slow. I mean, how much they are either converging or how much they are diverging. See, hence the name. Clever, huh? The histogram tends to get bigger as the faster MA moves away from the slower MA. And the histogram gets smaller as the two MAs get closer, convergence. And this is the euro dollar on a 1 hour chart. And we have our MACD here. Now, the blue is indeed the slower MA. And the yellow, or the mustard color, is the slower moving MA. So remember, a bit like the moving average crossover, when the slower crosses above the faster, indicates a change in potential indicates the direction is possibly changing on and upwards. Let me get my little pen as well so we can see it, my laser pointer. The wider the bars, the bigger they are widening, so the more dramatic the move. The slower crosses the faster, again indicates the direction is possibly changing. So going on a downtrend, the larger the histogram bars are, the wider the difference between the two. So let's have a look. The slower moves above the faster, the bars on the histogram starts to get wider, and what we tend to see, indeed, the euro dollar changes direction and goes on an uptrend. The slower moves below the faster, the bars start to converge, start to widen, indicating a potential slowdown or sell-off. Again, the bars aren't so dramatic though, so it's not such a dramatic sell-off. The wider the histogram bars on either end, the more dramatic the change in direction is. Moves above it, again, the slower moves against the faster. Again, the euro dollar does indeed change direction, but again, the bars are only narrow, slightly wider than this time, so it does indicate that there is a pretty much dramatic, semi-dramatic move upwards. Moves below, histogram bars are widened, showing that they are widening apart quite rapidly. Indeed, we see quite a larger down move there. Moves above it, histogram bars not so wide, but does indeed change direction, but not so dramatically. Actually, let me go back to the slide. And then we see they sort of almost touching each other, indicating a range. This is the cable on a 30-minute chart. Remember, the blues are slower, mustard colors are faster. Breaks above the slower, so the faster breaks above the slower, change direction, the market opens up highwards. The histogram bars are widening, means quite a dramatic move. Moves below it, indicates a change in direction. Indeed, the downtrend happens. Down it again, change in direction, again above. This time, as you can see, the histogram bars are getting quite wide, showing quite a dramatic move upwards. Moves below it, histogram bars are quite wide, showing quite a dramatic move downwards. And again, moves above it, histogram bars are start widening, and indeed there is a change in direction and it's quite a dramatic move upwards. The loonie. a 30-minute chart. Blue passes below the mustard, so the faster crosses below the slower, indicating indeed a change in direction. Blue moves slightly below the mustard, so the faster below is the slower. But again, if you look at the histogram bars, they're not very wide, showing that it's a very slow decline. And as you can see, realistically, really the market is actually in a bit of a range there. It's not till the histogram bars start to widen around this stage that we do see more of a dramatic move downwards. Faster goes above the slower, change in direction. Again, histogram bars widen quite wide, showing indeed it's more of a dramatic move upwards. And here, again, really just sort of touching it, showing that the market is indeed ranging. And again, sort of ranging. Not a real dramatic signal. Gold on a daily. Faster crosses below the slower, does indeed change direction. And the histogram bars there, you can see it really quite start to widen here, and it does quite a dramatic fall. Here, again, gives us a bad signal, not a really good signal, because the blue crosses below the mustard and the market continues to drop. Maybe it's capturing this ranging period here, but it's not dramatic enough, gives us a bad signal. Here again, not really giving us a clear signal because the market is on free flow. It's not till here that it actually is giving us more of an accurate signal, crosses above it, and indeed the market changes direction and starts moving upwards. Again, more of a ranging signal here, and it's not till here it gives us a clear indication, a clear pattern that the market's changing. Faster goes above the slower, and indeed this histogram bar starts to widen. One of the other, probably the most popular, or one of the most spoken about, and lots of educational people do and talk about the relative strength index, is the RSI, the relative strength index. Now, this is probably infamous, extremely famous, and is one of the most used or watched momentum indicators. Doesn't mean it's the best, because in my opinion, like I've just showed you with the MACD, indicators don't always work. They work sometimes, but not always. So you should always rely, again, in my opinion, on your trading on this. But the infamous relative strength index is indeed a momentum indicator, which can be used to measure if an asset is, again, like we said, overbought or oversold areas. Now, the RSI has a value range between 0 to 100. Okay, and the theory is that if the value is above 70, the asset is then potentially overbought. And that could indeed cause the market to sell off. And if the value drops below 30, the theory is that potentially the indicator is indicating that the market is oversold, and that may mean the market may then be encouraged to jump into the market, start to buy again, forcing the asset up higher. So let's have a look at some examples. This is the cable, the British pound, US dollar on a daily chart. Okay, now remember, ranges in 100, 70, okay, and 30. 70, potentially overbought. 30, potentially oversold. So let's have a look. RSI is at 70. And what happens? The market starts to sell off. And again, this is my point. Not all indicators work all the time. And this, again, is giving us mixed signals here. Again, is at the 30 level. Market doesn't really react, continues on its downward momentum, so it's giving us a mixed signal. It is sort of giving us a hint that maybe we should start to get ready. Eventually, the market does indeed kick in and starts to buy in again at the oversold levels, and the cable starts to rise. Again, range trades really doesn't really give us a dramatic signal at 70. The market continues to sell. Ranges this bit here, not very dramatically. Starts to sell off again. Doesn't give us a clear indicator or clear message till this point. Again, hits the 30, oversold level. Market jumps in, and indeed the cable starts to rise. Approaches the 70 level, this point here, and indeed the market starts to sell off again. Doesn't really do us anything, even doesn't give us an indication of a jump up higher, because it doesn't come to oversold. Eventually it does. Market starts to react, hits the 70 level, market starts to sell off again. There. Let's look at another example. This is the US dollar Japanese yen on the 30-minute chart. Excuse me. Approaches the 30 level, oversold, and the market jumps in and pushes the cable up. Hits the 70 level. Indeed, the market starts to sell off again. Again, going sideways, not giving us a clear indication either way. Approaches the 70 level, and indeed, the market starts to sell off again. Let's look at one more. WTI oil on a daily. Approaches the 30 level, market starts to buy in again because it's oversold. Hits the 70 level, market starts to sell off again because it's overbought. Hits the 30 level, market jumps in, starts to buy in again, pushing the asset higher. Again, doesn't give us a clear indication, doesn't give us a clear signal the market will continue to rise. Hits the 70 level, and the market starts to sell off again. Up and coming educational events, the remainder of April. Of course, we have the 30th of April was how I got to understand pivot points. And then, of course, I will release the May webinar schedule. If you wish to speak to me, by all means, you can email me at james@strattonmarkets.com, or indeed, you can be part of the exclusive group of followers, my great number of followers, which of course I'm joking, I don't have a great number of followers. On my Twitter account, my handle's @jtruskothic. Sometimes give market updates and market views in my own particular fashion and style. Before I wrap up, don't forget we'll be talking about online trading and CFD trading, and like all types of investments, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out the way, can I wish every single one of you a fantastic day. Thank you for joining me tonight. And until next time, every single one of you, trade safe.